Non-current liabilities refer to the obligations that are expected to be paid after 1 year. It means that the obligations that are more than 1 year. The example of non-current liabilities are long-term notes payable, bonds payable, and mortgage payable. Long-term notes payable is actually similar to short-term notes payable, except for that the terms of the notes exceed 1 year. Long-term notes payable frequently issued to purchase fixed asset. Now, look at journal entry for long-term notes payable. To record the asset purchase, the company should debit the name of asset and credit long-term notes payable. Explanation should be to record asset purchase by signing long-term notes payable. Step 2. We should record the adjustment of interest payable at the end of accounting period. Therefore, the company should debit interest expense and credit interest payable. So explanation will be to record accrued interest for all long-term notes payable. At the end of the long-term notes payable, the company should record payment of notes and interest on the maturity date. Therefore, we should debit long-term notes payable, interest expenses, interest payable, then credit bank. The explanation will be to record payment on the maturity date. Now, look at example F in your tutorial book. This is the question about the long-term notes payable. The Syarikat Seri Merinding purchased a cracker processing machine with a price of 25,000 on January 1st, 2012. Payment of 5,000 were made by using check and the remaining by signing notes payable of 20,000 for 5 years. The interest rate is 8% per year. The accounting period ends on December 31st every year. Therefore, the question asks to prepare the journal entry to record transactions on 2012 and the payment of notes payable with interest on the maturity date. This is the information from the questions. Machine price is 25,000 on 1st January 2012. The payment made is only 5,000 by check. Notes payable signed is 20,000 for 5 years. Interest rate is 8% per annum. Accounting period ends on 31st December. So, step 1, to record the asset purchase, we shall record it at the date of 1st January 2012. Debit machine 25,000 and credit bank 5,000. Credit notes payable 20,000. Explanation will be to record machine purchase by signing long-term notes payable. Step 2. To record the adjustment in interest payable expenses at the end of accounting period every year until the maturity date. Therefore, for the first year at the end of accounting period, we should record 31st December 2012 debit interest expense 1,600 and credit interest payable 1,600. Why 1,600? Because the interest rate is 8% and the notes payable signed is 20,000. Therefore, 8% times 20,000 we got 1,600. The explanation will be to record accrued interest for on long-term notes payable. Step 3 is to record the payment of the notes and interest payable on the maturity date at the maturity year. At the maturity date, 31st December 2016, we debit notes payable 20,000 and interest payable 6,004, interest expense 1,006, then we credit bank 28,000. Explanation will be to record payment on the maturity date. Okay, now see why the interest payable is 66,400. As you see here, the calculations for the interest expense: year 1, year 2, year 3, year 4. Okay, 1 year is 1,600 times 4 years, therefore we got 6,400. So this is the interest for year 1 until year 4. So therefore the interest payable is 6,400. For the interest for final year will be at 31st December 2016 is only 1,600. So this is the interest for year 5. That's why we record here interest expense for 1,600. So add together this one, you will get the total for the bank credit. So this is the way to do the step 3.